Hello everyone. On this video we are going to discuss the new lease accounting standard IFRS 16. This is a very new topic for our ACCA F7, P2 and P7 papers. This is Habib Rahman, and after watching this video, if you have any queries, please feel free to contact me. IFRS 16 establishes principle for the recognition, measurement, presentation and disclosure of leases, with the objective of ensuring that lessees and lessors provide relevant information that faithfully represents those transactions. Now I'll explain the main difference between IAS 17 and IFRS 16. In IAS 17, the lessee and lessor has to classify the lease into two types, either finance lease or operating leases. And the lessee will recognize assets and liabilities for only finance leases, not for operating leases. But now IFRS 16 introduces a single lessee accounting model where the lessee has to recognize asset and liability for all leases. There is no classification as finance lease and operating lease for lessee. But remember, the lessee can elect for an exemption for recognizing the asset and liability for a lease and account for lease payment as an expense on a straight line basis over the lease term, or another systematic basis for the following two types of leases. Number 1, short-term leases. Number 2, leases of low value assets. Short-term leases means a lease with a term of 12 months or less and without a purchase option. Please remember, the lease term is 12 months or less than 12 months and it should not contain a purchase option. And leases of low value assets are leases where the underlying asset has a low value when new. And underlying assets qualify as low value only if two conditions apply. Number 1, the lessee can benefit from using the underlying asset. Number 2, the underlying asset is not highly dependent or not highly related with other assets. The lessee can elect for the exemption of short-term leases only by class of underlying assets. But the exemption of leases of low-value assets can be made on a lease-by-lease basis. Now we will discuss how we will identify a lease. That means the definition of a lease. Okay. A contract is a lease, or a contract contains a lease if it conveys the right to control the use of an identified asset for a period of time in exchange for consideration. The right to control the use is conveyed to the lessee only if the lessee has the following two rights. Number 1, the right to direct the asset's use. That means the lessee has the right for what purpose the asset must be used and how the assets must be used. Number 2, the lessee has the right to obtain substantially all the economic benefits from that use. When we explain the definition of the lease, we said a contract is a lease or a contract contains lease. That means the contract may contain other elements which are not leases, such as service costs. These other components must be separated out from the lease on the basis of standalone prices. And this is very similar to the allocation of transaction price to the performance or performance obligation, that what we already discussed for IFRS 15. The definition also includes the asset must be identified. An asset is typically identified by being explicitly specified in a contract. But an asset can also be identified by being implicitly specified at the time it is made available for use to the lessee. But where a lessor has a substantive right of substitution of the asset throughout the period of use, a lessee does not have a right to use an identified asset. In this situation, this is not considered as a lease. But remember, a lessor's right of substitution is only considered substantive if the supplier has both the practical ability to substitute alternative assets throughout the period of use and they would economically benefit from substitution. Okay, great. Till now we discussed the objective of the standard, the main difference of IFRS 16 and IAS 17, the exemption for the lessee and the definition of the lease. Now we will discuss how this been accounted in the books of lessee. We already discussed that under IFRS 16, it's a single lessee accounting model. That means the lessee has to recognize an asset and a liability for all leases. Upon lease commencement, a lessee recognizes a right of use asset, which representing its right to use the underlying asset, and a lease liability representing its obligation to make lease payment. The journal will be debit right of use of asset, credit a lease liability. Initial measurement of right of use asset should be at cost. This cost includes the amount of the lease liability of lessee towards the lessor and any lease payments made before the commencement date minus any incentives received, plus any initial direct cost incurred by the lessee. Examples are handling cost, installation cost, any professional fees paid, and finally the initial estimate of dismantling and any removing cost at the end of the asset's useful life. Subsequent measurement of the right of use of asset, we have two choices, either cost model or revaluation model if it's an IAS 16, or fair value model if it's an IAS 40. So under these models we have to depreciate our right of use of asset. The depreciation period will be the useful life of the asset only if the lease transfers the ownership of the asset to the lessee, or the lessee has an option to purchase the underlying asset and that option is expected to exercise. For all other situations, depreciation period will be the earlier of the end of useful life and end of the lease term. So then, what is meant by a lease term? A lease term is the non-cancellable period for which a lessee has the right to use an underlying asset, plus periods covered by an extension option or periods covered by a termination option. I'll explain these two options. Okay, we'll put in an example. Assume the lessee has an 5 years non-cancellable period and he has an option to extend this for 3 more years. That means in total 8 years is there. Do we consider this three more years? Yes, only if the lessee is reasonably certain that he is going to exercise that option. If at all it is not reasonably certain, the lease term will be only 5 years. We'll put it in the other way. Assume the lease term is 7 years and the lessee has a termination option after 5 years. So, if at all the lessee is reasonably certain not to exercise that option, the lease term will be 7 years. Or if at all the lessee is certain that he is going to exercise that termination option, the lease term will be only 5 years. Now we will consider the measurement of lease liability. Initially, the lease liability should be measured at the present value of future lease payments towards the lessor. And these lease payments must be discounted at a rate which is implicit in the lease. If this implicit rate is not readily available, then the incremental rate of borrowing, which is the rate of interest that lessee would have to pay to borrow the funds necessary to obtain an asset of similar value. The subsequent measurement of lease liability will be like our amortized cost for other liabilities. The carrying amount or the opening value will be increased by the interest rate, that is the implicit or the effective rate of interest, and that interest charge should be on the outstanding balance of liability, and this interest will be charged to the P&L as a finance cost. And the amount will again reduce by the lease rentals, lease payments, and will reach at the closing balance. So the working out will be opening or the outstanding balance plus effective minus installment, you'll reach at the closing amount. And these format will change based on if at all the lease payment is based on arrears or advance. So that's it for the accounting for lessee. I'll summarize this. The main changes for lessees, regardless of any lease, he is not classifying the lease into finance lease or operating lease. He has to recognize an asset and a liability, and the asset will be depreciated using cost model or revaluation or fair value model, and the lease liability will be increased by the effective or implicit rate of interest and reduced by the lease payments. Now we will discuss the accounting by lessors. Please careful, there is no change for lessors accounting from IAS 17 to IFRS 16. The lessors continue to classify each leases as an operating lease or a finance lease. A lease is classified as a finance lease if it transfers substantially all the risk and rewards incidental to ownership of an underlying asset. Once if identified it's a finance lease, the lessor will de-recognize the asset and he'll recognize a lease receivable from the lessee. All other leases are classified as operating lease. For operating leases, the lessor will continue to recognize the asset and he'll depreciate that asset. And the lease rentals will be recognized as an income on a straight line basis. So that's it, friends. This was a quick explanation of IFRS 16. If you have any doubts or any queries regarding this IFRS 16 or any other accounting standards, please feel free to contact me. Thank you.